Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Iren.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. And I think our mission today is to really cut through what might be one of the most confusing tickers out there right now.
It really is, because when you say the name Iren, you have to stop and ask which one.
Exactly. You absolutely must clarify because they are just fundamentally opposing investment profiles.
On one hand, you have this, stable European utility.
And on the other, a high-growth AI infrastructure play that's trying to build the future of the cloud. It's a real tale of two stocks.
It's almost jarring, isn't it, to shift from, bleeding-edge, high-performance computing to municipal water services.
The difference could not be starker, and that dual identity is why you have to do this analysis. You're choosing between chasing high-alpha risk and, well, absolute capital preservation.
So we have to look at them completely separately. Let's start with the one getting all the headlines, the high growth story.
Right. The AI Iren. They've rapidly transitioned their whole focus from, the volatility of Bitcoin mining to defensible recurring revenue and high-performance computing, or HPC.
And AI cloud services.
And the financial results, they really confirm this pivot is succeeding with just incredible velocity.
So what are the numbers looking like?
Their full year 2025 revenue hit a reported $501 million. But the real headline, the true inflection point, is Q1 of fiscal year 26.
Okay.
Revenue surged 355% year over year to $240.3 million.
Wow. In one quarter.
In one quarter. And critically, the bottom line flipped from a previous loss to a record net income of $384.6 million.
That's not just turning a corner.
No, that's hitting the gas pedal on an open highway.
Okay, let's unpack that velocity because, frankly, numbers like that, they sound a bit unbelievable without a real defensible moat. This can't just be about putting servers in a warehouse.
It's not. Their proprietary advantage is all in the technology, specifically their direct-to-chip liquid cooling systems.
Right, the cooling. Why does that specific tech matter so much right now in this AI race?
It matters because power consumption is the single largest operating expense. It can be, 40 to 60% of a provider's budget. And traditional air cooling just can't handle the heat from modern GPUs efficiently. By using direct-to-chip liquid cooling, they slash the energy needed for cooling.
Which improves their unit economics?
Radically improves them. And when you combine that specialized cooling with their access to very low-cost renewable power, you get their secret weapon.
Which is the margins.
Extremely high gross profit margins, around 68% in their recent results. That margin is the difference between surviving and thriving.
That high margin is the foundation, I get that.
Yeah.
But it needs validation. You need the big players to buy in.
And that leads us straight to the major catalyst that proved the strategy. The massive multi-year AI cloud deal with a major hyperscaler.
And for anyone unfamiliar, a hyperscaler is one of the giants. Think Google, Amazon, Microsoft.
Exactly. This deal is reported to be worth $9.7 billion over multiple years.
That is a staggering contract size.
It's the ultimate validation. It proves their tech is ready for prime time. And we've seen the market react to this through what we call cluster buying.
So institutions are piling in.
Big ones. We've seen major institutions like Barrel Capital, Jane Street, and Hood River all accumulating shares, driving institutional ownership up to 41%.
And what's interesting about a name like Jane Street is that they're often quant-focused. This isn't just, sentiment. It suggests they believe in the mechanics of the build-out.
That's a great point. It's conviction rooted in those unit economics we just talked about. But to deliver on that, you need fuel. You need capital.
Which brings us to the recent capital raise, reported up to $4 billion.
Exactly. You need that capital to secure the expensive NVIDIA GPUs and expand the data centers right now.
And that's what the $4 billion is for.
It is. But here's the really compelling part. The company currently uses only about 16% of its total secured power pipeline.
So 84% is still runway for future growth.
It's a massive runway. Analysts are watching this and projecting the AI segment could generate around $3.4 billion in annual recurring revenue by 2026.
Okay, that's the bullish thesis. But let me introduce some friction here.
Go ahead.
If the story is so good, why did they need financing tools that made the market nervous, like convertible notes? Doesn't that signal a funding gap or some uncertainty? It adds a layer of execution risk.
That is the core of the bear case.
Mm.
It is absolutely why the stock pulled back after that announcement.
So what's the reason?
The transition from Bitcoin mining, which, generates liquid cash every day, to this capital-intensive AI infrastructure requires huge upfront spending.
Before the revenue really ramps up.
Exactly. So there is definite execution risk, and the dilution fears are real. Investors are basically betting that the massive future ARR outweighs that painful short-term dilution.
So if that's high risk, high reward.
Yeah.
Let's just put on the brakes entirely and look at the second Iren.
The Italian integrated utility.
Yeah, and the difference is it's philosophical.
Yeah.
We're moving from chasing exponential tech growth to securing reliable cash flow.
And this company, it is the definition of stability and efficiency. They're vertically integrated, managing essential services like gas, electricity, water.
Things everyone needs no matter what.
Exactly. Forget volatile GPU pricing. This is the ultimate predictable business.
And the financials reflect that, I assume.
They do. We're looking at consolidated revenue of 978.6 million euros in Q4 2024. Steady, consistent 5.2% year-over-year growth.
Solid.
Their EBITDA margin expanded to 38.2%, and their net debt to EBITDA is comfortably managed at 2.9 times. It's the definition of steady as she goes.
So the moat here isn't tech. It's what, geography?
It's geography and regulatory structure. The strength is their vertical integration and, effectively, a regulatory monopoly in crucial regions, mainly Emilia-Romagna.
Meaning about 90% of their revenue is regulated.
And let's define what that means for you. It's a captive audience. The regulator guarantees them a reasonable profit margin.
Which is the exact opposite of the cutthroat competition the AI company faces.
Completely, and this translates directly into shareholder appeal. The company offers a robust 4.1% dividend yield.
And is it covered?
Fully covered by their free cash flow, which hit 412 million euros in 2024. That's a defensive income stream you can actually bank on.
So what are the upcoming catalysts for this one? It's not a big tech deal.
No, it's more predictable. We're looking for the Q1 2025 earnings release with consensus EBITDA around 285 million euros. But more importantly, there's an investor day in May.
And what happens there?
They'll unveil their Iren 2027 capital plan. That's where investors get crucial visibility on future free cash flow and dividend policy.
I see. There's also this potential for external funding, right, for their green projects.
Yes, exactly. They have a hydrogen pilot project, which is highly eligible for EU Green Deal grants. We're talking a potential 80 to 120 million euros.
Which is non-dilutive funding. That just boosts the free cash flow outlook even more.
Significantly, and it's not just the fundamentals. Technical analysts are seeing confirming signs here too.
Such as?
A very classic golden cross pattern confirmed on the charts back in January.
And for anyone who isn't a chart expert, that's just when the short-term moving average crosses above the long-term one. A bullish signal.
A strong technical uptrend signal, yes. And that's being reinforced by insider buying from the CEO and CFO and accumulation by institutions like BlackRock and Fidelity.
So everyone's confirming the same thesis. Stable, predictable growth.
Right. But now for the whisk on this side, the main one is something called regulatory lag.
Okay, what's that?
The Italian energy regulator, or ARO, controls tariffs. If operating costs spike, the regulator might not adjust those tariffs immediately.
So the company has to absorb those costs for a while.
Exactly. It pressures margins until the review is done. And there's also concentration risk. About 55% of their revenue is still tied to that one core region, Emilia-Romagna.
So let's bring it all home. Let's synthesize these two completely different stories.
The high-growth AI Iren is a pure play on market-driven volatility and, as you said, execution risk. It's a multi-year hold where the whole thesis rests on them successfully ramping up that huge deal.
That's almost a binary bet on their future capacity.
It is. And the Italian utility Iren is a multi-year hold focused on regulatory and political stability. It's about income, stable cash flow, and regulatory protection.
So if you're deciding between them, you're really just choosing your risk profile.
That's it. Analyst projections suggest the AI play is poised for significant alpha, maybe 40 to 60% upside over 12 months.
But only if everything goes perfectly.
Only if. Conversely, the utility play offers capital preservation and, an expected 15 to 20% upside into its upcoming catalysts.
So you sacrifice that exponential growth for certainty and yield.
Ultimately, the fact that two such wildly different companies are called Iren just highlights the grand market dichotomy we see every day.
Right. The choice between chasing high alpha risk in the AI build-out
versus securing reliable cash flow from stable, necessary infrastructure. The key for both is just understanding which Iren you're actually investing in.
If you want more deep insights into market movements and catalysts like these, be sure to subscribe to Smart Wealth with Joshua for more daily stock analysis and catalyst talks.